Are you a business owner wondering how to maximize the value of your company? Today, we're diving into the fascinating world of business valuation. Whether you're an entrepreneur, an investor, a business owner, or simply curious about the financial mechanics behind a company's worth, understanding valuation methods is crucial. So grab your notepads because we're about to unpack the secrets behind determining a business's true value. Having spent 15 years as a financial advisor and the last 15 as a real estate investor and broker, I've seen it all, from booming startups, established companies, and everything in between. But one question frequently pops up: how much is my business actually worth? Well, there's no one size fits all answer, because valuing a business is like solving a complex puzzle. Different methods provide different pieces of the picture, and it's the job of the analyst to put them all together. Let's explore the three main approaches. Number one, income-based approach. Imagine a business as a money-making machine. Income-based approaches value the company based on its ability to generate future cash flow. Think of it like this: the more money a business is expected to make in the long run, the higher its perceived value. There are two main variations of this approach. Discounted cash flow, or DCF, is the gold standard for income-based methods. It involves projecting a company's future cash flow, then discounting it back to its present-day value. It's like looking into a crystal ball and figuring out how much those future earnings are worth today. Capitalization earnings are also called cap rate. This method takes a company's average net income and divides it by a capitalization rate. This rate reflects the risks associated with the business and the expected return on investment. Also, market-based approach. Think of this approach like comparing apples to apples. Market-based methods value a business by looking at similar companies that have recently been sold. It's all about finding comparable businesses in terms of size, industry, and financial performance, then analyzing their sale prices to determine and estimate the value of the company in question. Market multiples. This method uses ratios like price to earnings or revenue to compare companies to its peers. Think of it as a shorthand way to value a business based on similar market trends. Precedented transactions. This involves analyzing recent deals involving similar businesses. By looking at the selling pieces of these comparables, we can get a good idea of the market's valuation for a particular type of business. And finally, number three, asset-based approach. Sometimes a business might not have a strong track record of earnings, but it might be sitting on a goldmine of assets. Think real estate, equipment, or intellectual property. This approach values a company based on its fair market value of its tangible and intangible assets. It's like saying, forget future potential, let's look at today's value of the company holdings. And finally, liquidation methods. This estimates how much money you could generate if you were to sell all of the assets and pay off all the debts. It essentially reflects the breakup of the business. Book value is simply by looking at the company's total assets and subtracting its liabilities. While it provides a basic snapshot, it doesn't account for intangible assets or future potential earnings. So there you have it. These are the main approaches to business valuation. Remember, there's no magic formula. Sometimes the best approach often involves a combination of these methods, depending on the type of business, the industry that you're in, the projected financials, and the state of the economy in the area that you're in. So if you're curious to learn more about business valuations or have any questions, leave a comment and we'll get back to you. And don't forget to subscribe for more insight on business valuations and how you can make better financial decisions. Thank you so much for your time. We'll see you next time.